So, you're interested in investing in the stock market, but getting started might be difficult. Where does one begin? The most common myth about investing is that it's just for the wealthy, and that you need a lot of money to get started. This may be true a decade ago, but not anymore. Welcome to Gray Skies Media. We're here to help you invest in your future. Please, do us a favor and hit that like and subscribe buttons for more content like this. For this video, we're only going to focus on investing in individual company stocks. And we'll tackle the difference between index funds, ETFs, and target retirement funds on another day. Let's get started. Number 1. Make sure you're ready to invest. Yes, you think, I'm ready. But do you have all your bad debt paid off, and do you even have savings? Bad debt means unnecessary debt, like a car loan or credit card debt. If you have a 26% interest rate on your credit card balance, then you'd be losing more money than you can earn from investments, even at 15% average returns. Make sure that you have an emergency fund. It's a good idea to put 3 to 6 months of your living expenses into your emergency fund. That way, you're covered if something unexpected happens. If you're in need of cash and don't have an emergency fund, when the market takes a downturn, withdrawing the money at the wrong time will cause you to suffer avoidable loss. Number 2. Understand the basics of investing. Bottom line, you don't want to lose money in the stock market. Choose your stocks wisely. Learn about pump and dump scenarios and understand that the market fluctuates. Learn to keep your emotions in check and avoid FOMO. As a newbie, avoid penny stocks. The most important thing you can do to become successful is to get an investing education. Understand that in the stock market, you want to buy low and sell high. Look for the dips. And as a newbie, avoid short-term investing as it is highly risky. Look for long-term investment options with secure returns to minimize risks. Number 3. Determine what money you'll use to invest. First, let's talk about the money you should invest in stocks. The stock market is no place for money that you might need within the next 5 years. Don't use your emergency fund, money you'll need to make your child's next tuition payment, next year's vacation fund, down payment for your home, a home equity loan or line of credit, credit card advances. You should only use money that you've earmarked for investing that doesn't interfere with your ability to pay your bills. Number 4. Create a portfolio plan. When you're starting out, define your goals. That's how much money you want to make in the long run. Your age is a major consideration, and so are your particular risk tolerance and investment objectives. Ask yourself these questions, then create a plan for getting there. Then identify the investment options that meet your needs. Use this as your guide when making your investment decisions. Number 5. Choose your stocks. The most important aspect to keep in mind is choosing the right company and the right time. Everyone has that one cousin or overzealous friend who is always pitching the next big thing. This will require you to research the companies by looking at such things as their past performance and their financial reports. There are many considerations in buying individual stocks. Here, we highlight a few important concepts to master before you get started. Diversify your portfolio. Invest only in businesses you understand. Avoid high volatility stocks until you get the hang of investing. Always avoid penny stocks. Learn the basic metrics and concepts for evaluating stocks. It's a good idea to learn the concept of diversification, meaning that you should have a variety of different types of companies in your portfolio. In the beginning, stick with businesses you understand, and understand that buying meme stocks may seem like a great way to build wealth, but hold off until you have more experience. Once you've identified a company that meets your qualifications, don't invest right away. Put it on your watch list and watch for a while. Wait for a price to dip, Once the stock price goes down, buy. This will give you a good entry point and profit once the company goes back up. It is critical to keep your emotions in check when investing. Understand that markets are extremely volatile, and even the finest companies can suffer losses. Don't panic or make rash decisions in response to any significant changes. Wait, be patient, and assess the issue before making a choice. Never let emotion influence your buying or selling choice. You will frequently, if not always, be incorrect and will be doing exactly what the market wants you to do. Before you get started with your own money, consider paper trading first. With paper trading, beginners can build real experience without having to risk real money. Number 6. Open an investment account. Once you're ready to start investing, you'll need a brokerage account. The type of account you'll open is dependent on your investment goals. For most people, this means choosing between a standard brokerage account and an individual retirement account. If you want easy access to your money, you'll want a standard brokerage account. However, if your goal is retirement, an IRA is a great way to go. These accounts come in two main types, traditional and Roth IRAs. And there are also some specialized types of IRAs for self-employed individuals and small business owners. IRAs have great tax advantages, but there are big penalties if you withdraw them before you retire. 401k. If you're not quite ready to jump out on your own, consider starting with your company's 401k retirement plans. It's a great place to start as a new investor. Some companies will match your contribution. Say you contribute 2% of your salary. Your company could contribute another 2% equivalent to the amount you put in the plan. Robo-advisors. If you're already contributing to your 401k, or if your company doesn't offer one, consider robo-advisors. Just as the name suggests, these are robots that offer financial services such as building portfolios and selecting investment options on people's behalf. If you don't know much about investing, robo-advisors are a great option. The most surefire way to make money in the stock market is to buy shares of great businesses at reasonable prices and hold on to the shares for as long as the businesses remain great. If you do this, you'll experience some volatility along the way, but over time, you'll produce excellent investment returns. What do you think about the video? Please, let us know in the comments and don't forget to like and subscribe. Click on that bell icon so you never miss an upload. See you in the next one.